The S&P 500, of course, so we are right at the anchored volume weighted average price from the election. That's that orange line right there. And this market has gone through every potential level of supply on the way up. It didn't find resistance at the 20-day moving average. It didn't find resistance at the anchored VWAP from the all-time high. It didn't find resistance at the 50-day moving average or the year-to-date anchor. So that's why I always call these levels of interest, not a place to do business. Now, on to the 30-minute time frame on the right, we did have a higher high, but we came back in, and that 5-day moving average is flattening out. Next week, it wouldn't surprise me if we started to see a little bit of profit taking, maybe come down, undercut this a little bit, and then bounce up, give people a false sense of confidence, get trapped below the 5-day moving average. Then we can start to look at some of these levels, such as the anchor off of the recent low in April. But we are still giving the benefit of the doubt to the buyers here, although the light is kind of turned yellow in terms of where we are in the S&P 500. And this is also the 61.8% retracement up in this zone. NASDAQ, that you can see that's a little bit more obvious, meaning from the all-time high to this year's low, we've come perfectly to the 61.8% retracement. That's what this line is. That's what that 61.8 says over there that you can barely read. But that 61.8% retracement comes into play along with the anchor from the election, that's the orange line, and that black 200-day moving average. So both of these markets are having trouble, so far at least, with the 200-day moving average. Now, on the shorter term time frame here on the right, what we see is we saw a higher high and then it came back in. Oftentimes we see from failed moves come fast moves, similar to the peak over here. That from that failed breakout came a fast move lower. We have the possibility of that happening here, and I think just as long as we're below this level, be a little bit defensive. We might even run up through there, do this, and then start to come back down. But I think you've got to be looking at this and saying, we just ran from 430 up to 490. That's a 15% move, basically. So a little bit of profit taking would not come as a surprise to me. Maybe down to the anchor from this low. That would bring us into this zone near 472. There's nothing here indicating that we are ready to decline, but we're becoming more neutral. And after a large advance into an important zone of potential supply, and it becomes more important because we have the possibility of 3 different groups of participants coming to the same conclusion in the same area. That is the Fibonacci traders, the year-to-date, I'm sorry, not the year-to-date, but the anchored VWAP from the election and the 200-day moving average. At each of those levels, there might be a group of participants who's saying, this market has rallied 61.8%, so I'm going to stop buying up in here. Others will say, hey, it's 61.8%, I'm going to start taking some profits off my bounce trades. Others will say it's 61.8%, let's start selling short. So what we have there at that 61.8% retracement is less demand and more supply. We don't see that evidence yet, but that's the thinking of how people use these tools. Same is exactly true with the 200-day moving average and the anchor from the election. So if we have these different groups of people coming to the same conclusion in the same area, is it too obvious that it doesn't work, or does it become self-fulfilling in this area? We'll find out next week, but I know that it's prudent to be cautious in here.